If you're absolutely convinced the future says you're going to pay less in tax, if you're absolutely convinced of that, don't do it because you'll just be frustrated. So that's one reason. And it always gets down to what you think the future holds for you. It's not me telling our clients what to do. It's me just walking them through the analysis so they can make a great decision. So number one, if you think you're going to be in a lower tax bracket, if you will, or pay less in tax, don't do it. Secondly, why else would you might not do it? I can't think of another reason. Hello, everyone. This is Ron Corser with Cornerstone Retirement Partners. Welcome to today's program. It's going to be a good one. I always think they're always good, but we're going to talk about that thing called a Roth conversion and what it might do for you, what it might not do for you, and everything in between. Again, I'm Ron Corser with Cornerstone Retirement Partners. If this little program or this topic has already gotten your attention, give us a call at 616-301-2581. That's 616-301-2581. Or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you, get you information on the Roth conversion, the good, the bad, the ugly of all of it, and we'll go forward from there. So let's talk about Roth conversions. Why would I bring that up this year? Well, for a couple reasons. Number one, the federal government is actually encouraging everybody to do Roth conversions. What do I mean by that? They passed a rule here this year, it's called Secure 2.0, where they encouraged everybody, if they wanted to, all retirement plans, 401k, 403b, those can move money from your employee contribution and your employer contribution, not from the tax deferred part, but into the after-tax part called the Roth 401k or 403b. That's a major change. Also, any additional catch-up provisions for people over 50 are also, they have deemed to be going into the Roth portion. Why would the government encourage us to do that? Well, think about this. We have what, about a $35 trillion deficit? They desperately want our tax dollars. And they're encouraging everybody to put money for retirement in after-tax accounts. They want the tax money now, and they'll deal with whatever they're going to do down the road because they're not going to stop spending money. We all know that. And that's just going to keep happening. And so ultimately, what does all that spending do to us as we get ready for retirement or enter retirement? The potential for tax increases is very high. It really is. In fact, if nothing happens, if nothing changes, taxes are going to go up in January 2026. Why is that? Because the tax bill that was passed and put into place in 2017 was only good for 10 years. It's going to be sunsetted. So all that high-priced talent we send to Washington, D.C. is going to say, well, we didn't do anything to change taxes. Yes, you did. You allowed the current tax bill to expire, and now taxes are going up. What does that mean? It means, for example, the 10 or 12% bracket we currently enjoy is going to go to 15%. The brackets are automatically going to go up, which means the amount of taxable money that they hope to get from us is also going to go up. So let's use one of the government programs for our benefit and perhaps to slow down their spending just a little bit. So let's talk about the Roth. What is it? A Roth 401k is a provision in the 401k that allows you to put all of your contributions, all of the employer's contributions, not in a tax deferred account where you get a tax deduction. You don't get a tax deduction on the Roth, but it goes into the Roth on an after-tax basis. That means when you get ready to pull money out, as long as you follow certain rules, that money always comes out totally tax-free. It doesn't even go onto your tax return when you take it out if you obey the rules. So it really can be an incredible account to have. Why? Well, think about this. In terms of taxes, right now, a married couple, let's say a married couple has income of between $75,000 and $94,000. That includes Social Security that's taxable, taking money out of IRAs, and everything like that. That puts them right now in the 12% bracket. In 2 years, that's automatically going to go up to 15% bracket. But here's where the rub comes. And it's something when we talk to our clients, all of it, we always talk about the issue of survivorship income. When one spouse dies, that spouse, starting the following tax year, starts to have to file taxes as a single taxpayer. So follow me if you can on this. Let's say somebody has married taxable income of $90,000 after deductions. That puts them in the 12% bracket right now. One of the spouses die. Yes, there's a reduction in income because the Social Security payment goes away. But it's not going to go away that much because here's the 12% bracket for a single person. The max is $47,150. So think about this. If nothing else changes and one spouse dies, the following year, the surviving spouse pays more in tax. Yes, they perhaps have a little less income, but they're going to pay more tax on that. And one of the things that really frustrates me as a citizen of this great country, and it really is a great country, is all the politicians always tell us how they want to take care of single women. And yet the tax code really doesn't do that after the husband dies. But that's the last political statement I'll make today, I promise. So why would somebody want to do a Roth? Well, here's a couple reasons. Number one, you think when you get into retirement, your tax rates and what you actually pay in tax. And that's always the key, what you actually pay in tax going forward. Simple question. You think it'll be about what it is today? Do you think it'll be lower? Or do you think it'll be higher? What are taxes going to do? Most of our clients say, well, I think they're going to go up. Okay, if they're going to go up, what can we do about that right now? If we haven't done anything, we can automatically start to create a Roth IRA strategy. And it is a strategy. We can take clients' accounts with a 401k, 403b, and start to say, well, let's move money into the Roth portion from that account, not into the tax-deferred account portion. Second thing we can do is, depending on your income level, we can actually create additional Roth IRA accounts outside of your employer account where you can put money into that. It'll grow tax-free and come out tax-deferred. Where will you get that money? If you've got a lot of money sitting in a money market fund in a bank and given certain income limits, you can create Roth IRA accounts for yourself and your spouse. What's the advantage? One of the things about a Roth IRA account that you create outside of 401k, whatever money you put in, you can always take out. No ifs, there's nothing to worry about. There's no consequence to it. You may have to leave growth there for a while, but they're pretty liquid, and it's a great way to accumulate money on a tax-free basis. So that's another reason to do it. A third reason, did I go to three? A third reason is this, is if you have tax-free accounts, Roth accounts, you get to manage your tax bill a whole lot better than if you're just subject to taking money when you need it in retirement out of an IRA. So let's imagine this. Let's say that you need $20,000 out of an IRA account, either a tax-deferred account or a Roth account, and you have both. You have the choice to take it out of both. Well, if you take it out of the IRA account and you need $20,000, you're probably going to have to take out 25 or 26, depending on what your tax rate is. So you're going to have to take out more. You're going to create more taxable income. You won't get a thank you note from the United States Treasury, but they'll appreciate your higher contribution. On the other hand, you can take it out as a Roth and not pay any tax on it. I'll give you a great example. I have a client who's a retired pilot for one of the major airlines. He had a great Roth account savings. He had great IRA stuff. He gets a pension. He's going to do pretty well. It was his goal in life when he retired, and he was forced to retire last year, to either remodel his house or buy a new house. And he hadn't figured out what he was going to do yet. And out of the clear blue, he got a chance to buy a home very close to where he lives in the same town. It was kind of, as he said, a forced sale because the single owner, a man, had been given a terminal talk by the doctor and he wasn't going to live long. So they just wanted to unload the house. He got to buy that house. It was an all cash sale. What he did was he cashed in a substantial part of his Roth IRA account rather than take that money out of his IRA account because he's on Social Security and he's also on Medicare and he has to be concerned about those costs and impacts. So see, you get a lot of advantage when you have a Roth account. So why to do it if you think taxes are going to be higher in the future? Number 2, for survivorship income issues. Number 3, so you can better manage your tax bill while you're paying taxes year in, year out right now. So what about why wouldn't you do it? If you're absolutely convinced the future says you're going to pay less in tax, if you're absolutely convinced of that, don't do it because you'll just be frustrated. So that's one reason. And it always gets down to what you think the future holds for you. It's not me telling our clients what to do. It's me just walking them through the analysis so they can make a great decision. So number 1, if you think you're going to be in a lower tax bracket, if you will, or pay less in tax, don't do it. Secondly, why else would you might not do it? I can't think of another reason. I really can't, ladies and gentlemen, unless you just don't want to pay tax right now, because if you convert money, it becomes a tax bill today. And that maybe will not make you happy because nobody likes to pay more in tax. And the other part is it may, depending on how much you do, it may increase your Part B premium for Medicare. So those are 2 reasons perhaps not to do it. But here's what I tell folks when I try to help our clients. Let's do a Roth IRA analysis conversion strategy. It's just not something you do willy-nilly. What we literally do is say, because we do taxes for our clients here in our firm, we say, well, what happens if we take another $10,000 or $40,000 or $100,000 out of your IRA this year and convert it, assuming everything else stays the same as it was in 2023? How much more would you pay in tax? And then we have 1 more year at these lower tax rates. How much more would you pay in tax the following year? So it's an analysis we do to help you get a really good handle on what the tax bill is going to be. So you can make a decision. Look, it's like that old Fram oil filter that a lot of us remember. You can pay me now or pay me later. We're always going to pay the Treasury Department of the United States government money because every dollar we have has a tax consequence to it. So we help you make that decision. We help give you clarity on a conversion strategy. We help give you clarity on what might happen if you just take all of your 401k or 403b assets, quit putting them into a tax deferred account and put them into the Roth account. Because we do taxes, we can help you with this. And that's the right way to make a decision on how you should handle Roth coming out of a 401k or 403b or Roth conversion. So if what I've said makes some sense or touched on a hot spot with you, give us a call. Again, I'm Ron Corser with Cornerstone Retirement Partners. Phone is 616-301-2581. Our website is www.cornerstone-rp.com. Let me just end with this. A lot of people just hope that they're going to be okay when it comes time to pay their taxes. We take that a step farther. We take the hope and we build it into reality. We can help you create tax advantage strategies going forward that not only will help you while you're living, it will be great legacy for your family when you're no longer here and in heaven. So give us a call. I'm Ron Corser, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you. So guys, have a good week. Have a good day. And bless all of you. And talk to you soon.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.